And welcome back to Day Trading for You, ladies and gentlemen. One of the most important things about day trading is to know the overall trend of the market. When you try to buck it, you lose money. When you follow it, you make money. What I'm going to be doing here is offering targets for market moves, when you should be biasing long and when you should be biasing short. With that said, let's get to today's chart. The stock chart you're looking at is the IWM, which tracks the Russell 2000. This particular pattern that developed between February and May of this year is a wedge. Now, wedges more often than not will define direction. As you can see, the wave patterns are always counted in 5, A, B, C, D, and then an E. Now from E, that is where the break is expected. In this case, it honored trendline support and then broke straight up. Well, what normally happens is when you take the value of A to B, you add that to the low of the wave, it gives you a base target for the move that is what would be considered conservative. Meaning expectation should be that it's actually going to go above this by as much as $3. That's 170.66. 174 is probably the high end of the target for this range. The reason I drew this particular line was so that everyone would know, if you're invested in small caps, the Russell 2000, that this is where risk of systemic failure starts. Now we have some other things suggesting that this might be a fairly good number. You'll notice up here, %D is right at 80. That's a danger zone. Look back here where we hit it, made it above the line, and then we sold. But that was a moderate sell, called a technical correction. Look over here where we got real close. You can see that that was more than a technical correction. The market makers were out of stock and they wanted people to panic sell, so they gave it a really nice hard fall. So we've got this indicator telling us basically that the market is under stress on the high side. Does not mean it can't go higher. Let's go down here. Our PPO value is basically telling you that it's at the high end of the range, but still has room to move if it wants to. The ADX value is starting that run that often calls a high. Also, not there yet, suggesting that we have some additional upside, which is very much consistent with our target in the 171. Could be 172 or 173, but this is the absolute minimum you would anticipate before any problem would start to develop. Now, at this point, you can see that we had a period where we had compressions. This is bearish. When you see these lines moving together, this is bullish. And the only way that perception changes is when they both reach levels. This one should be at least 35 or higher. You can see the last move, that was a move down, was in the 35 range. Another thing that suggests that money has been pouring in at an unsustainable rate is right down here, your money flow. It's been green for a very long time, which suggests market makers have continually emptied their coffers, and they're probably in need of a nice decline in order to pick up some additional stock. Do we have anything else to worry about with respect to the IWM? When you flip to a news perspective, you have to appreciate two things are going to be occurring very shortly. One, we very often get a technical correction and set a July low. We are in June, so we are not far from that need for a large technical correction mid-year. But this year could be very different. And the reason I say that is we have an election in November that is going to choose whether the House and the Senate flip to the Democrats or remain in control of the Republicans. That is what's called risk. It's a risk on into November. Now, as long as polling data supports the market's desires, there is no risk on. But if polling data starts to suggest that something's going to change and they don't like the change, then the market's going to start pricing in a political change. What's going to happen, we don't know. Nobody has a crystal ball to tell you which party's going to have a good day on November, but one of them will. So these are things that are going to affect the market psychologically in the coming months. Do we get a traditional summer sell? See, back here in August, it started in June, fell into August. That's a traditional summer sell. Are we going to get the same thing here? And if it does sell, see this line right here where it broke out? That is support. That is very heavy technical support. So you're looking right now at about an $11 move down, but once we get up above this, you're looking at a $14 move down. That's a substantial amount, almost 10%. We also notice that this is going parabolic. In other words, it's going straight up. Markets never do that. See how they tend to creep? Now, when they do a parabolic move, they need a long time to unwind that buying pressure, to relieve it so that it can go higher. In this case, we're going parabolic, but what's important here to note is you'll notice the 200-day moving average. The further away from the 200-day moving average you get, the higher the odds of selling. You'll notice here we got a very long distance. You notice here we got a very long distance. You notice here we got a very long distance. And when we get to today, it's even bigger. So consistent with expectations, we're looking for a rally to continue short term to the 171 to say 173 range. And then we should see something more like this, a rather tragic decline. That's expectations. So short term bullish, but near term it's going to reverse. That's our expectation for the IWM. Day traders, you should continue to play weakness until it reaches this line. Stop investing. Once it gets to wherever it's going to roll over, then you need to start thinking about playing strength. Every time it has a little rally, short into it. Every time it has a little rally, short into it. See these gap down morning rallies? Short those things. This was actually a small gap up and a rally. Short it. But you'll notice it filled our gap over here, which was important. Here was a gap down rally. These don't happen very often when you get into the stronger falls until you get one where that gap is just huge. And if it keeps on selling, that tells you get out and flip long, especially when it's near the 200-day moving average. Even if it's not going to rally from that point, you can always anticipate a bounce, and a strong one. As in here, first hit, bounce, very strong. So, sold off again, then gapped up, sold off again. That's what set our A low. But it brought back up, because if it's going to remain support, you can't close below it. It can pass through it in the day, but it needs to close above. And look what happened, it rallied. Okay, ladies and gentlemen, that is our current and future forecast for the next few weeks. We're looking for a near-term high. Once that near-term high has been inset, we're going to anticipate a much stronger sell-off. Just thought I would give you a heads up on where the patterns lie and what to expect in the near future. I hope you'll take the time to like and subscribe before you leave, and I'll see you in the next video.